Aditya Sood, fund manager at InCred Asset Management, on the show now. Aditya, so many earnings misses and disappointments this quarter. We've seen a slowdown in urban demand, and it's visible across FMCG names, retail, auto, mall operators, chemical consumer durables too have seen a moderation in demand. In your portfolio, did you have exposure to any of these companies where we've had these big misses? And what are you doing now? How are you readjusting it, and what is the call?
Sure. Thanks for having me on the show. So I think earnings need to be looked in context of 25% earnings growth post the COVID low that we see. Essentially, I think so. If you look at the long-term earnings growth trajectory, it is trending pretty much in line with the nominal GDP growth, which is closer to 12 to 13%. On top of this, what has essentially happened is that, and this is a call that we took, 6 months back in terms of being massively underweight on financials, is that, there is some bit of asset quality which is mean reverting. It is not deteriorating at a very, very rapid pace, but essentially it is mean reverting as I speak to you today. So our bet was that, essentially you had the highest net interest margins, the third highest credit growth in the history of financials, and there were certain banks which are having more recoveries than slippages, essentially, which was leading to a negative credit cost. Now, clearly, that 20 basis point of credit cost, just as an example, it has been reverted now to 70-80 basis point and that has led to a bit of a disappointment. Now, if you add on top of this, what we are witnessing in auto, essentially is both these sectors are cyclical in nature. And what we are seeing is that, there is a bit of a disappointment, which is obviously passenger vehicle story. But obviously, two-wheelers, after doing so well for last 3 years, have also, marginally disappointed. So that is a cyclical bit. On the IT bit, in terms of earnings, obviously, we believe that, this sector will have stronger dollar revenue growth to come through. So these are the, IT is a global cyclical, as you are aware. So in this entire, sort of scheme of things, we were overweight on healthcare, we were overweight on IT, and we were within consumer, we were overweight on rural place versus urban. And that is the reason why, the portfolio performance has held up for us. Although I must confess that at this juncture, there are interesting opportunities because there was a lot of element of froth in the market. And now we have seen, 30, 40, 50% correction in a lot of stocks wherein we had froth in the past. Now, this is going to be a very, very earning specific market for next, 6 to 12 months. Because what we are witnessing is that, there are some companies will continue to gain market share in a declining market. And that needs to be, evaluated very, very critically.
Hi, Aditya. Good afternoon and good to see you. When Aditya, I wanted to ask you about RS Systems. And this is in the backdrop of slowdown issues. Blackstone took over the company. It was doing roughly around 400 crores or thereabouts. After many, many quarters, it's still doing around 440 crores. Everyone would have thought there's cross-selling opportunities and there'll be a big scale up from here on. Tell us your take.
So I think so. One has to, evaluate this from a capability standpoint, and the goal that Blackstone possibly has here, and it is a well-publicized objective that, from $200 million or revenue run rate, they want to make it a $1 billion revenue run rate. Obviously, this is going to be a combination of both inorganic and organic growth. Now, if you look at this company, last 10 years, the top line growth has been, 15% odd. It is a small base that they have. Clearly, our expectation is to, in the phase one of their strategy, is to cross-sell to the Blackstone portfolio companies. What they highlighted in the last earnings call was that essentially 15 of the Blackstone portfolio companies are, clients for them today. So it is going to be both a combination of hunting and mining. We believe that there are very few companies which have got, and the capability gets reflected in the average revenue per employee billing rate that they have, which is, closer to $55,000. From an IT standpoint, I think so it is a very high capability company. Now, it is a question of, ramping up. They have already, successfully integrated Velatio. as an acquisition target. So we do believe that, this 15% revenue CAGR is going to surprise over a period of time. Now the key is going to be sizing here. So what we are resorting to is a small weight in the portfolio, but we do believe that we want to be aligned to product companies for the next decade rather than, investing into companies which are too overly dependent on services. And that is the reason why, this is one company that clearly stands out.
Or the short-term pain and play the longer theme. You're in for the longer run.
Yeah, I would like to believe so. I think so. From a IRR perspective, it doesn't make sense for a private equity player to come into the company. And what we have seen in the past is that, if you look at pretty much, if you have to list down IT companies, large and mid cap both, most of the IT mid caps are owned by private equity. It is very easy to run a IT company possibly from a standpoint of a private equity.
Got it.
Okay. You spoke about now many interesting opportunities with the fall that we've seen in the market. Are they centered around the themes that you like, healthcare, IT, rural consumption, or are you even looking at other themes? And if yes, tell us, give us some ideas on how to spot, these individual stocks, because it's not top down anymore.
I think so. It is more a capability question, for one end of the portfolio. So if you look at, Tejas, for example, who would have imagined that, when Tata's took over as promoters, the top line will become bottom line, and it has all happened over a 3-year horizon, essentially, and who would have imagined that Tejas is going to report, this kind of blockbuster earnings. So if you look at, Tejas just as an example, earlier this was a fiber to home company, essentially, and now you have seen wireless, which was questioned by many that, whether Tejas has a right to win to execute on the wireless side. I think so. They have done a phenomenal job because that is there in the numbers to see. Because for the first time in the history of telecom in India, we have seen BSNL gaining subscriber base over last 3 months. And that is in contrast, sharp contrast to the entire telecom industry. Now, if you look at Tejas, what they said in the last earnings call was that, essentially they are going to always also focus on railway coverage. I think so. They have a very, very bright chance of implementing Bharat Net type project in Egypt or going global with these credentials that they have. So I think so. This is one example of capability. Secondly, what we have seen is that, essentially a lot of companies, a lot of small caps in India would have a long-standing track record. So if you look at the CDMO space, the reason why we find, Newland Labs very, very interesting is it is a very, very high capability company in our view. And the reason is that, they are heavily dependent on as a real true, upcoming CDMO player. They are very, very heavily dependent on R&D. So if you have to benchmark the R&D spends, if you have to benchmark the R&D capability, if you have to benchmark the compliance track record that they have, and now this new pipeline of 5 odd drugs. So that is one side of the story. The second side of the story in the portfolio continues to revolve around companies wherein earnings were beaten down, and this is like Stovecraft or Egarchi. Essentially, all these companies have gone through a massive capex cycle in the last 3-4 years. And in a down cycle, they were gaining market share. And now what we see is that, they are growing at a really very exponential pace. All they need is a market environment wherein obviously they continue to grow. So if you look at Stovecraft, an example, and if you have to benchmark their growth rate to a TTK or a Hawkins, which is key competition for them, they have gained market share in a down cycle. They are expanding at a very, very rapid pace. So our expectation is that, if you are a capability driven company, you will have, exports as a major thrust area. And this is where, Stovecraft is excelling at this juncture, because what we believe is that, what is top line today, in next 4 to 5 years, 50% of their top line today could be, only represented by the export opportunity that they have. So I think so. It is about consolidating market share and then gaining eventually. On the financial side, our focus area is on banks, which are really very, very well managed, and we do believe that HDFC and City Union Bank are two such franchisees. So if you look at, City Union Bank from 2010 to 2019, essentially it was the best performing banking stock when the banking sector itself was not doing well. And what we have seen of late is that, they have started to grow now. valuations are much more undemanding. They got re-rated to 3.5 times price to book. Today, the bank is trading at 1.2 times price to book, which is very, very inexpensive to our view, because it is a very, very high quality franchise. They are very, very conscious about the NPS cycle. So I think so. These are some of the elements that will clearly stand out.
Got it. All right, Aditya. And valid point you make on Stovecraft was a big underperformer, but now they're outgrowing the industry. Most are not growing or seeing a degrowth, and that one's growing. And the management has told us here on CNBC-TV18, as they start scaling up, margins will pick up because now they're able to cover the fixed cost as well. So explains why that stock has bounced back. By the way, the stock.
For more news and updates, all you need to do is follow CNBC-TV18 on all of our digital platforms.